This is predominantly our basics of buying program. So I'm going to be covering the basics of buying a home since I am a pre-purchase housing finance counselor. It's going to be the kind of steps building up to and getting up to the closing point, we call it, where you kind of close the deal. But we're also going to talk about how important it is to think about the days after closing. It's not just having that goal in mind that's important. It's thinking about the steps that get you there and what you need to be anticipating after as well. In terms of what it is that we're trying to accomplish with this workshop is just bring some perspective. We want to make sure that we're putting information and knowledge in the hands of people so that way they can make more informed decisions. Knowing what skills and steps it is that you'll need to take is something that we want to put on your radar. And then also importantly, we want to foster the experience of you living in your home as opposed to for your home, trying to foster joy in the process of you owning and purchasing is ideal and what it is that we would like for you. I ended up packing a good amount of content into these slides, so I could be going a little bit quickly. Given that, I want to put out there that if something ends up not really like making sense, please stop and let me know. Feel free to ask for me to say something differently or re-explain something. This is a small enough crew that I feel like if you don't understand something, probably somebody else doesn't. And feel free to like come off of mute or raise your hand and express that. Some questions it might be appropriate to save till towards the end, but I'm going to trust your discretion in being able to identify that so that way we can still try and move through the content. A little bit of notes about our virtual learning space is that we're all individual and wonderfully unique people who are going to approach credit use, finance, and money from a variety of perspectives. It's really important when we're engaging in these conversations and with these ideas that we're open-minded and respectful of the fact that people are coming from different spaces. And so how something I say resonates with you might resonate with somebody differently. And we're going to respect that people have different experiences from us when they choose to share. I'm going to say that ideally, we'll operate from the space of like being muted to minimize background noise, unless there's something that we want to like share to the group, and then definitely just you can come off and say, hey, I have a question. But just to minimize background noise. If at some point you want to like turn your camera off really quick so that way you can do something, feel free to do that as well. You're not like obliged to stay on screen. But participation is encouraged, and we're going to have some activities and questions, and feel free to raise your hand or use the chat box, please. If you end up having a technical issue and you get disconnected and you need to log out, feel free to just sign back out and sign back in using the same link, and I'll be able to let you into the space. I also have the note here, introduce co-host, and that is my boss, Barb, who is also on the call, and I just want to give a shout out to her because she's the reason that I know all of this stuff, and she's fantastic. So she's going to be here and serving as some support for me today, and I appreciate that. So when we think of housing, we recognize that there is a housing continuum, and we all fit into that at different places and spaces at different times. It's important that we figure out what is right for you. We want to take a moment and reflect that while homeownership is right for some, it's not necessarily right for every household. You may need to ask a series of questions or get assistance to help determine what it is that some of your housing options are. For folks here in attendance today, I think it's safe for us to assume that you're interested in learning more about home ownership, or it's something that you're considering if you don't currently already, like Nicole, one of our shared equity owners. But buying a home can be a wonderful thing. However, it's a big goal. It takes a good amount of time, energy, and money to achieve that. It's not really based on how much you want it or if you deserve it. It's not always about how hard you've tried or what it is that you've done. You know, the process to buying has many steps that occur over time. You have to be willing and able to complete all of the steps of purchase in order for it to happen. For many of us, it can be far from a straight line of, I think I want to buy, to just back up and put the moving truck right up by the garage now. So that's the purpose of this workshop, is to give you a general idea about the path, identify some key points, and then also provide you with some resources that are out there to help you decide what it is that your next best step is. So we have a list of like pros and cons that we're going to delve into in terms of home ownership, some benefits and some reasons to buy a home when we've had folks come through counseling or just engage with the community. The prospect of building wealth or equity is something that comes up as like a big motivator for people being interested in buying. I'm going to explain the concept of equity in a home now. So home equity is the value of the home minus any debt held on the property, and then a mortgage is a loan on the property. I think some numbers could kind of help demonstrate this. So in accordance with like Burlington area prices, we have this little square box over here that is valued at $200,000. So we are going to pretend that you are trying to borrow $190,000 from the bank in order to secure financing for this $200,000 Burlington box that we are so excited to acquire. You put 10K down on it when you go to buy this house, and you're borrowing $190,000. The 10K that you're putting down is considered your portion, and that is your equity. As you continue to make mortgage payments towards the principal and interest, you continue to build up this equity portion. Eventually, you can own it all. And so that it is the financing terms it is that you're agreeing to would kind of determine the timeline it is that you pay everything off by, and then also whether or not you choose to like make more than the minimum payments each month, for example, or occasionally add more to the principal. But you are able to build this up over time. Another reason that people are really interested in owning is just like the security. There's like emotional security that's attached to ownership. Sometimes it's like an element of like people feel it's safer to have a fence or be in this particular area. So there's that sense of security as well. There's a little bit more control. You're able to customize things a bit. When it comes to your own space, you're able to pass it on to family or as an inheritance. There's a great deal of pride in owning something. There's a larger connection to your community and your neighbors. I want to stop and ask if there's any questions about kind of some of the benefits it is that we covered, particularly since I broke down some equity numbers. Fantastic. And again, feel free to just type something in the chat or come off of mute if something comes up. We can acknowledge some of the cons that are also like something to consider when you're trying to purchase. Owning costs more than renting. So we're going to have a kind of like a breakdown of this. I think that I'm going to try and bring up an annotation tool so I can point on the screen and make sure that you can see it. Give me just a second. So this column is how the costs of renting can kind of pan out, and then this is owning. So I'm going to address it column by column. A lot of times there's a bit of a misconception that a mortgage is usually cheaper than rent for like the same like square footage. And this depends on a multitude of factors, you know, the area in which it is that you're occupying, the size of the residence. But generally speaking, if you're looking at, you know, in the same area at the same size, it's usually the mortgage is a little bit higher than the rent amount would be. Rental insurance is usually cheaper than homeowners insurance. So we have like a $15 charge and a $60 charge here. When you rent, you don't pay taxes. When you own, you usually are paying those into an escrow because the amount is pretty large and it becomes due in like a larger sum down the line, or you can also be paying those regularly. The utilities are also usually a little bit cheaper when you're renting as opposed to owning. So this is just kind of a breakdown of some of the common costs of renting versus owning and how it's usually a little more expensive. And then notably, this column over here isn't taking into consideration like trash, repairs, and lawn care, and a few other factors that do fall onto the homeowner once you are owning. You know, you don't have like a landlord that's necessarily keeping some of these things up. Additionally, you usually need 8 to 12K or more for closing costs when you're purchasing. We're going to break this down a lot more in a bit, but this is separate from the down payment, and it includes things like an appraiser and a lawyer and a home inspection, a few other things, and we'll get more into that in a bit. There's also a good amount of money that's needed for like repairs and maintenance of the home when you need to replace a boiler or a section of your roof. There's a good amount of financial risk and responsibility that comes with ownership. It requires a little bit more time, energy, and money to own. This one is seen as kind of a pro and a con. You're a little bit more, it's a bit more permanent or tied down. So sometimes that's like good and you want to be settled into a space, but at the same time, it's like you've signed the paperwork that's going to put you in this space, you know, for a while. We have in our notes here, I think that this is just so funny. It says, please no one run away, disconnect, or exit Zoom. Good news, when you are on a home buying team, you are not alone. There is a team of people who can help. We're going to talk about each of these people, and then also, I didn't even really plug this yet, but I think that I have some slides on this in a bit. We do counseling here at Champlain Housing Trust. So our team is able to guide folks through multiple parts of the home ownership and pre-purchase process. And then we also have a post-purchase counselor if you buy through within our program. So there's some more ongoing support there. But yeah, we're going to talk about each of these people, and we'll introduce who it is that they are and what it is that they do in the home buying process. So there's your counselor, which would be somebody like me or Barb, or we hired David and Antoinette recently. There's a lender or mortgage loan officer who works to obtain financing. There's a realtor who helps you find the home and negotiate the purchase process. There's your home inspector who's going to give you information about the physical, like property. And you'll also have a lawyer that represents your legal interests in the purchase process. And all of us are attempting, to be unbiased professionals dedicating to helping you make sense of the process, particularly within the shared equity program. And a lot of the folks that we see come through on the open market, it's a good group of people around here mostly that I've had the experience of engaging with, which is nice. But so Champlain Housing Trust isn't the only home education, home ownership center that's in the state of Vermont. So there's people that do my job and Barb's job all across the state. If you're outside of Chittenden, Franklin, and Grand Isle, where we serve in Champlain Housing Trust, these are the organizations that are affiliated kind of with different parts of the state. And this is going to be recorded and stuff, so and we'll send it out afterwards, so you'll be able to reference that there. You can find a program in your area to help at vermonthomeownership.org. All of these organizations are HUD certified and NeighborWorks chartered members. I don't have like a map for all of these across the nation, but these exist all over the place as well. So in different states, they have them too. We're going to introduce Kai Beyer for a case study. She's going to serve as a kind of example when I'm demonstrating some of the concepts, particularly I think in the credit and financial section. So Kai is an awesome single mom who lives in Milton. She has a good paying job, a little bit of debt. She doesn't know what her credit is or her credit score is, but she doesn't think it's too bad. She's got a little bit of savings and a small inheritance, and she is ready to begin her home buying journey. She's been renting an apartment for the last 6 years, but has been thinking about buying for about the last 2. She wants this to be the year that she buys a home for her and her child. At this point, I'm going to plug our home buyer education program, which is a workshop that we give in a few different formats. We have it in person, we have it over Zoom, and then there's also a self-paced virtual option that folks can access. I really recommend doing the in-person or Zoom ones though, because we put them on and I think that they're really engaging. We have a certificate program where you take this class and then that gives you access to a counselor. The class is $99. So you take the class, you have the counseling, and then this provides you with support person that you can make contact with individually to assess your one-on-one situation. At the one-on-one appointment, we review your credit report, and we also assess your affordability in a way that is similar to how it is that a lender would do that, and we break down your numbers. I also put in any special programs that are specific to your household, like based on income and household size. I address those with you and a lot of other things. So we can do more one-on-one assessment there if you have that interest and capacity. Kristen says, do you offer scholarships for the home buyer class? So we have internal opportunities where we've received funding to kind of cover this for our staff. I know that there's some money that has come in for our programs, but not for eHome. Barb, can I tap you in to just make sure that I don't give any misinformation here regarding scholarship opportunities? I think that there's we also have partnerships with CVOEO. I know that we've gotten funded to do the counseling that way as well for a multitude of households. But in terms of individual folks that are reaching out seeking a scholarship opportunity, I feel like we've mostly done it internally and through community partners at this point.
Yeah, that's true. So we've gotten, some funding through New England Federal Credit Union to do really to help people of color. So we've been able to make some of our workshops free. We've gotten funding for veterans on our website and within our home buyer education registration. There is a program that if someone is below a certain income level based on their household size, they could ask for the fee to be waived and for a letter of hardship. And there's some information on our website about that. I'm also happy to email it around to any of our community partners who want to know more about that.
Thank you. I am glad that you pointed out that it's on the website as well, so that way it's like we can access the more extended literature there. Thank you. Good question. I'm going to move along if that's okay. Thank you. So one of the things that home education can kind of help you do is assess your needs versus your wants when it comes to the home purchase process. In a perfect world, we'd be able to get all the things that we need and want at the price that's just right. However, realistically, we need to weigh these out and weigh out our preferences and be flexible. I might say this more than once, but if you hear it more than once, it just means it's important. Happy homeowners are going to make the right compromises. We have an example here of this wicked cute little couple that's like, we want a secluded 20 acres surrounded by hills, streams, and trees, but within walking distance to shops, restaurants, and hot night spots. We want it to have a small, cozy feel, but also plenty of storage and it to cost less than what we pay in rent. I want this for them so badly. And to steal some language that Barb uses all the time, if I had a magic wand, it could make it happen, I would. However, we have this little arrow about a reality check ahead because we want to make sure that we are engaging with systems in a way that is informed in order to make sure that we're making the right decisions about how it is that we want to move forward. There are many things to consider when it is that you're buying a home. You know, what kind of like style is it? A single family, a condo, manufactured, the location, the travel time between work and school, price point, the bedrooms, and some of your personal preferences. As a counselor, we're able to help you weigh some of these priorities when you come in. And then also, I think that it's important to emphasize like the dependence that we can have on our community for some of these conversations and stuff too. I benefit a lot from processing with like my pals and friends and family. So just kind of talking about some of your needs and wants with other people can be helpful and informative. We've learned over many years that when people complete the home buyer education program plus counseling, they're more successful as homeowners. And this is also a form of pre-purchase education. So even without taking the entire workshop, we're making proactive steps to be more informed and minimize the risk of experiencing the stat I have is on delinquency in their mortgage. So less than 20% of owners who receive pre-purchase education are seriously ever delinquent on their mortgage. This shows that, you know, you're taking steps to be proactive and thinking ahead. So we're going to talk about some industry standards, concepts, and practices some more. When it comes to the mortgage world, credit is pretty much king. One of the first things that a lender is going to do when they're applying you for a mortgage is check your credit. Most loans are going to require that you have some experience with traditional credit, and this means that you have a credit report and a score. The score range is 300 to 850 with the FICO model, and this is the range that kind of has conquered the common shared financial space. A minimum score for mortgages is generally 660. Above it, 720 is even better. You're going to get better interest rates with a higher score. But again, the minimum is generally a 660. One of the reasons why it is that this is like even being considered your credit is because when you go to speak to a mortgage lender to get a loan, they're assessing you for one of the most expensive things it is that you're ever going to buy. Giving you hundreds of thousands of dollars to buy is considered a bit of a risk for a lender, you know. They want to see how well it is that you've handled your debts and financial obligations or your risk as a borrower in the past. And they don't necessarily want to be the first one to offer you a giant loan product. Good credit can help offset risk. When we're talking about traditional credit, it means that you have some credit accounts that have been reported to the bureaus and show up on a credit report. And I'm gonna move into an example with Kai here. So we pulled Kai's credit from annualcreditreport.com, and she got her FICO score from myfico.com, or in this case, we got it from Credit Karma and TransUnion. She realizes that she has a score above 660, which is a 674. So this is an indicator of the fact that she's been managing her credit obligations well historically. We like to encourage the use of this annualcreditreport.com website for the free soft pull of personal reports. Barb makes the joke that she does this every year on her birthday. She pulls her credit. That's kind of helpful in having the annualcreditreport.com piece considered. We recommend pulling your reports annually from the bureaus as a way to minimize fraud and identity theft risk, but also to make sure that you're verifying the accuracy of all of the accounts that are affiliated with like your name and social security number. Just quickly, the annualcreditreport.com is free. For myfico.com, I'm pretty sure you're paying for the score. So these are separate softwares and separate websites. For folks that don't have traditional credit, there are a few lenders who may be willing to consider non-traditional credit access. This is like the lender can ask for a copy of your utility history, for example, or your history paying a phone bill, or a testament from your landlord that says what it is that you've had in terms of your payment history for the last 12 months. So there is some flex, but generally speaking, the credit is king in the traditional financing options or what it is that we're talking about. So if you get through the credit requirements like Kai did with her 670 or 660 plus, the next thing that the lender is going to look at is your debt to income ratio. So optimally, you'll have less than 10% in debt in order to qualify for a mortgage to purchase a home. And I'm going to explain this a little bit more. So the lender wants to compare how much it is that you make to how much it is that you, or sorry, how much it is that you make to how much it is that you owe every month. This refers to what percentage of your income is spent on consumer debt obligations, like a car loan, student loans, credit cards, etc. If you have a large amount of debt in comparison to your income above the 10% number that I had mentioned, it negatively affects what it is that you have to spend on housing. Just want to make sure I'm not missing something. So the reason why it is that the lender is considering your debt in relation to your income is because that's how much it is that you have left to spend on housing, right? It's like they're assessing what is it that you owe to everybody else, so that way I know how much you have left to pay me, basically. That information gives them lets them know how much it is that you have left to spend on housing. When we do this in appointments, I just add up all of the monthly debt obligations that people have. It's usually like an auto loan and credit cards. And then we just compare it to their income and show how much of it is that like proportion is. So they're taking that into consideration to get you a mortgage number. So if you don't have a debt to income ratio above 10% that's eating into your affordability to agree, like we've gotten past credit, we've gotten past debt to income, then we're moving into the next assessment, which is affordability. So successful owners, the standard that has been agreed upon by like banks and feds and a good amount of research is that successful owners spend no more than 1/3 of their monthly income on housing costs. To determine the affordability, the mortgage lender is notably only going to take into account people that are listed as borrowers on the loan. So if your name's not on the mortgage, they're not going to be using that as a factor in considering it here. But affordability includes the amount you qualify to borrow in a mortgage, plus down payment and any special programs that help you buy the home. I'm going to move into the kind of breakdown of what it is that the monthly housing payments are. Oh, Nicole, hi, I see your hand up. What's going on?
No worries. So I had an employee last week and I didn't know the answer to this. I'm like, we'll have to ask. So I'm glad you're here. She is looking to purchase with both of her brothers. So is that something that people can do? They can purchase with siblings? Do they have to be like married or anything?
No, you don't have to be married. I wouldn't necessarily recommend this, but like you could hypothetically sign a mortgage with a random stranger, you know, like, so it's, you can have, like siblings on there. I was just talking with somebody last week who was getting a pre-approval for a house with his brother, because they're trying to do
Okay.
like a multi-unit purchase together and stuff, so
Yeah.
absolutely. You don't necessarily, it's different in the shared equity program and versus the open market notably as well. Like,
Okay.
in shared equity, if the person is going to be living in the home full-time, you need to make sure that they're listed on the application and that their income information is on your
Okay, because we're
application.
we wanted to put all the incomes on it, and I'm like, let me just make sure that we can do that. Okay, they're all gonna be on the mortgage, so all their incomes will count toward it. Perfect, thank you.
Is that bringing up any other questions and some of these other concepts that I brought up as well? Thanks. So the monthly payment obligations it is that we're like talking about and that we've kind of grouped together, we have an acronym for it. PIDIO is the acronym. It stands for principal, interest, taxes, insurance, and other. The principal and the interest, that's what it is that your mortgage is. And then these others are not what it is that your mortgage is for, and that's not included in that, and those are just additional. The other category varies a lot, and that can be like homeowners association fees or private mortgage insurance if you're buying on the open market, because we don't have that in the shared equity program. Or like CHT does have a $45 monthly fee. And that's to sustain access to like the counselor and existing programs and resources and stuff once you've moved in. So these are the three key assessments, and you can't really move forward until you have all three of them in solid shape. If you are borrowing with another person, you have to meet all of the credit standards, and so does the other person. It's not like one person can and the other person can't if you want their income to be assessed or considered for what it is that they'll lend you. For debt to income, lenders use the combined income and debts of all borrowers to determine a loan amount. So if you're like married, for example, they're going to do both people's debt obligations and income. For affordability, when you're talking to a lender, it's important to note that you're getting a mortgage for the maximum amount it is that you could borrow. And this isn't necessarily what it is that you like should borrow. They're using gross income to do all of these calculations, and we all live off of our net incomes. So it's just something to be kind of like considerate of when you're looking at what it is the monthly payment obligations are going to total up to be. This is often where it's really helpful to engage in home buyer education contents like today's class or in the 8-hour workshop that we do. So to show some of these concepts, we're bringing back Kai. She has a 674. She has 4 open accounts and 3 years of positive history. She's got everything paid on time. No late payments here. Paid off her car, 1 open student loan, has a credit builder loan of installment payments, probably at a local credit union or bank, and then an open credit card. In terms of her debt to income ratio, she makes $5,500 each month. And then these are her debt obligations is the student loan, the credit builder, and the credit card, and that's $450. So when we compare this $450 out of the $5,500 gross monthly income, that puts her debt to income ratio at 8%. This number is beneath the 10% standard that I had introduced on previous slides, which means that her ability to mortgage is not like in any way affected by her existing debt obligations. And then in terms of affordability, the mortgage lender calculated that Kai can spend $1,815 each month on her housing payment or her PIDIO payment. So that's the monthly amount that she's been approved for. And this means that she's been approved to mortgage around $280K to buy a house. The next slide is question time, but I feel like this one is kind of helpful to stay on for a second. Anything coming up? Oh, I see a question that came in through. Oh, that's Barb. You're so helpful. Fantastic.
I just dropped the fee waiver policy in the chat box for people. That's all.
Okay, so I'm going to move forward. I had kind of started to talk about like, you know, we're being approved based on our gross amount as opposed to our net amount, and being mindful of how much it is that things are going to cost you as you agree to pay them. So I think that now is appropriate to talk about payment shock. This is a big jump in monthly housing that a borrower isn't necessarily accustomed to paying. If you've been able to like reside with your folks for a little while and you're paying them like $400 in rent each month, but you've been saving for a long time and you now have the down payment and stuff, but your mortgage is about to be like $1,400. You go from a big payment shock in this example of 300 to like 1,400. It can be smaller, even a couple $100 can be a bit of a shock or whatever. But something it is that we suggest to minimize this. We have Kai here on this slide as a demonstration. So I think that it would be easier for me to verbalize this, that like we can pretend that Kai is this case that I'm talking about, and she was paying $300 a month to her mom, and she's about to sign up for like a $1,400 mortgage payment for this case. So to practice paying $1,400 each month, something that we suggest folks can do is open a savings account and then practice plugging the difference between their existing rent and their future mortgage payment into a savings account. So it's like the $1,300 in this case, or minus the rent she's paying each month. The difference between that, we're going to say practice paying that with like a separate savings account. So that way we're making that full payment in some version, and then like building up to it. Does that make sense? Thank you. We're gonna do a little bit of a participation activity here. Feel free to just do like a thumbs up or thumbs down on the screen, or you can type into the chat space. So the housing payment is comprised of the principal, interest, the taxes, insurance, and other. We want to know, do you think if the taxes, insurance, and other change, if any of those go up, do you think that impacts how much it is that you can mortgage? If you have the same principal amount, the same interest amount, that's still the same, but taxes, insurance, or one of these others went up. True or false? Do you think that this can change your mortgaging ability or how much you can borrow? So we've got a true in the chat space. This is yes, it can change it. No, it can't change it. Great. I saw you guys all point on the screen as well. It can impact how much it is that you can borrow. So I'll explain in this pie chart, we've got a principal and interest amount that we've been approved for of monthly $1,350. This is for Kai's demonstration with her $280,000 mortgage that she got approved for. However, in this case, now all of a sudden the taxes are $200 more expensive on this one. So instead of being able to get $280 for the mortgage amount, that dropped it down to $245. And it made the monthly amount that we're approved for smaller as well. So all of these kind of play off of each other. And this is something to take into consideration because like the taxes in Burlington are higher than they are in Milton. Thank you for your participation. Hey there, Kristen. I see your hand up. What's going on?
But after you get the mortgage, it cannot change, correct?
Oh, you agreed to 30 years of financing. That is, that's not going anywhere unless you like refinance, you transfer. Yeah.
Right. But ahead of time it can, but not after you've signed on the dotted line.
So the principal and interest cannot change, but the taxes, the insurance, or the others. So we had someone just recently, their HOA, their homeowners association fee went up by about $300 a month because they're behind on what they need for their roof replacement. So the pie, the principal and interest, is the only fixed part. Taxes, insurance, and other could go up or down.
Thank you for offering that very, very important clarification. Anything else? So there are many things that affect your affordability. The lender begins by looking at your gross monthly income and deducting any debt obligations to see what it is that you have over. So I had kind of talked about how your income amount minus any personal debt obligations it is that you have determines how much it is you have left over for housing. And that's then used to determine what it is you have to go towards those PIDIO payments that we were talking about. Some other programs and factors that can affect your affordability would be like if the interest rate is higher or lower, that can change how much it is that you're able to mortgage. The type of home can change how much it is that you're able to mortgage, you know, like a manufactured home versus a single family home. If you have a homeowners association, those kind of fees can waiver and impact how much it is you're able to mortgage. The property taxes vary from area to area and are pretty location based. A private mortgage insurance or guarantee goes away after you've paid 20% towards a home's outstanding like balance or value usually. But whether or not you have those payments or not is something that will impact how much it is that you can borrow. And then also there are special programs like closing cost and down payment assistance and other ones that are for like improving existing home features or accessibility needs and stuff that would impact how much it is that you can borrow as well. I feel like I've been stopping for questions a good bit, so we're gonna just move on ahead. So when I say closing, the closing is the day where the property transfers from the seller to the buyer. It's the meeting where all of the related parties are transferring this property. Lots of documents get signed, all monies are paid out, and the buyer leaves with the keys to the home. So a pre-approval is something that you're going to need for this process. It's a letter from a lender verifying your affordability and ability to purchase. It's important that you choose the right lender and loan product. You want to shop around to at least 3 different lenders to compare options and pricing. One place might have a special program that the other one doesn't. One place might have an interest rate higher or lower than the other one that just really is resonating with you. Once you choose a lender, you will begin a loan application and then get a pre-approval letter. Your loan application is complete once you have selected a home and signed a purchase and sales contract. And we're going to talk a little bit more about that in a minute. When it comes to finding the right home, there are a lot of places to find homes for sale, and the most common one is going to be the internet. Realtor.com is a good resource to find any home that's being sold through a real estate company. Special programs may have their own website, such as CHT's getahome.org, in order to see which homes are available on our shared equity portfolio. Notably, you want to be careful when you're looking at different websites because they can present information in ways that can cause confusion. So we have Kai here that has been snooping around on Zillow. And as you can see, she has found this 3-bedroom, 2-bathroom joint for $1,057 a month. However, Kai decided to look a little bit more carefully at that because she was like, that seems a little suspicious and low. So $1,057 is just the mortgage payment. It's not the taxes, insurance, or other housing costs. And that's also only the mortgage payment if you put down 20% of the value of the home. And this is $53K. So the real actual full housing payment here is more like $2,105. But just be mindful when it is that you're looking at listings. When it comes to shopping further, it's important to know the housing market and have representation when it is that you're buying a home. The housing market changes a lot from week to week, even day to day, and it's really competitive right now. So you want to make sure that you're putting your best foot forward. A realtor who serves as your buyer's agent can navigate the complex process of home buying. It's nice to have somebody that's an insider in the process. So we're going to talk a little about the role of a buyer's realtor or the buyer's agent, as opposed to like a seller's agent. A buyer's realtor can help you find and evaluate properties. He can help you understand the process and use your time a little bit more efficiently since they know where to look. They can provide you knowledge of the housing market about what it is that's going on in the current circumstances. They'll have access to all of the homes that are sold through realtors. They'll be able to help you negotiate an offer and get a signed contract. It'll be really helpful to have somebody support you in doing that. And there's also no additional cost to the buyer when buying a home sold by a realtor traditionally right now. This is changing around a little bit in terms of some like legal obligations to it. But as far as what it is that's like the standards right now and what seems to probably be going forward for at least a little while longer is that there's no cost to the buyer when buying a home sold by a realtor. You'll sign a contract with your buyer realtor notably, and that is going to kind of oblige you to working with them going forward. There's contingencies in those sometimes in case something comes up, but you're going to sign a contract in order to work with a person. So just make sure that you're picking somebody that is like listening to you and you feel like is helping you find what it is that you want. You may find that you have to go look at several homes before you find the right one. When it comes to looking at homes, a recent poll of home buyers in the 250K to 375K range could expect to look at an average of 15 homes. You'll typically spend about 30 minutes on the property. It's usually like a little bit longer if you can. Also, like the chit chat's fun and can drag it out. So maybe up to an hour as opposed to half an hour, but we're all trying to be respectful of each other's time at the same time too. You want to take notes while you're there. Bringing your priorities list is going to be really helpful in terms of being like, is this something that I need or is this something that I want? How much does this mean to me? And does that affect how much I want to like move forward or not with it? Taking notes is also really helpful because if you're visiting 15 properties, Nicole, I'll circle to you in 1 second. You're not going to remember which one had the shag carpeting and which one had the stair rail. So just taking notes about each address and the contact and having that all in front of your face will make it a little bit easier to assess things. Nicole,
I'll
what's up?
remember the shag carpet.
I got shag carpet and I love it
I'm like, you know, you'll remember that, sir.
although my cats are having a blast with it, tearing it up. So I wanted to ask a quick question specifically about shared equity. When I was chosen for my home, I wasn't allowed to look at it prior to being selected. So can you talk a little bit about that process? Is that change? Didn't know if it was a COVID thing, but I was selected and then I got to look at it.
It's still like a little bit with COVID brought us an opportunity to create virtual tours for people to access. And so it's able to give a really thorough introduction to the space.
Okay.
However, until someone has gotten to a certain point in the selection process, the physical visiting of the home is a little bit more limited because otherwise then it's like we haven't even finished screening everybody for selection and they've come and visit. So it just doesn't work out logistically very easily to allow for the kind of touring until you've gotten to a certain point in the selection process.
Okay. But that's just kind of the way it is with this program. It's not a COVID thing.
I'm not positive what it was before COVID because I kind of started my AmeriCorps term during that. So, yeah.
So prior to COVID, we actually used to do open houses where a gathering of people would gather in one building. Go figure. During COVID, of course, that went away and didn't happen. A lot of our buyers found too that, we're right now having unprecedented numbers of people interested. So we might have 12 or 15 people interested in one property. And so to have a seller have to have that many people kind of go through their home, and because only one of them is going to be selected, I think we sort of shifted into trying to be a little bit mindful of the seller, and saying, we're going to select the person and then allow you the full ability to walk through it, look at it, get your eyes on it, think about it, get the home inspected. We want you to do all those things, but we're doing the selection before we're doing the tours just to try and help the seller have fewer people go through. So I think that's going to probably stick around for a while.
Well, and the virtual tours are great. I mean, I literally look at every house because there's always someone looking, but the virtual tours are phenomenal. I don't know who you have doing it, but they do a great job. Thank you.
I think it's one of Melissa Carter's friends. All right, I'm gonna start to kind of speed up here. The last few slides are going to be some of the like special programs that we also talk about in Basics of Buying in the Home Buyer Education Workshop. I'm going to send these slides out afterwards. So that way it is that the resource coordinators have access to the list of what it is that the individual like programs are in the slide deck. I don't think that we're going to have time for me to like break down everything, but I think it's really important that I share that at least virtually. So looking at homes, take notes on what it is that you are prioritizing and need and want while you're there. And you're going to want to ask for a seller's property information report. This is a report from the seller on all of the known problems with the home, and this will help you prepare for ongoing maintenance and needs it is that you'll need to keep up with once you've moved in. You want to practice assessing based on your priorities, not necessarily your emotions here. So we're going to move into a purchase and sales contract. This is how it is that you create an offer, and we have like the counter offer and offer process occur. So an offer is where the buyer uses a purchase and sales contract to outline what it is that they're offering, what they're asking for, and the process by which everything's going to happen. It'll contain the purchase price, the appraisal, the home inspection, and a closing date. At that point, using the purchase and sales contract, the seller either agrees to what it is that's been offered by signing it, that's how it is that they agree, or they counter offer by adding an item they require in order to make the agreement. So back and forth, and then the purchase and sales contract becomes a binding contract once both the buyer and seller have outlined their expectations and agreed to these. The buyer and seller will both sign the contract. You're committing to what it is that you say that you're going to do in this offer, and the seller is committing to what it is that they say that they're going to do. Once the seller accepts your offer, you can't really change your mind the next day. Nicole, is your hand still up from earlier? Okay, I just wanted to make sure. Thank you so much. So the clock kind of starts ticking once the purchase and sales contract is signed. From contract to closing is usually 45 to 60 days. There are many things that need to happen, and most of them have a deadline. And it's important to know the timelines in your contract. You're going to need to inform your lender, lawyer, and home inspector of any special programs it is that you're utilizing. Your counselor or lender is going to be able to help you a little bit with some of that too. The lender is going to want to make sure that the home is worth how much it is that they're allowing you to mortgage. You want the home to come in as worth more than the value of the purchase price or at the value of the purchase price. And so that's what the purpose of an appraisal is. It's a determination of the value of the home as compared to other recent like type sales. And the lender will order an appraisal once the purchase and sales contract has been signed. This is happening afterwards. In Vermont, homes are sold with the help of a lawyer. This fee is included in closing costs and paid for at the closing. It's usually flat, typically around $800 to $1,000. Your lawyer represents your legal interests in the purchase process. So they're going to write or review the purchase and sales contract. They'll also conduct a title search to make sure that there's not any existing like liens or outstanding debts that are against the house that it is that you're trying to mortgage. They'll represent you at the purchase or the closing. When it comes to wanting to protect your investment and the longevity of maintaining your home, you want to make sure that you have a home inspection. The cost of a home inspection is usually around $400 to $500. This is where a home inspector performs a visual examination of the home in order to provide their professional insight into its condition. The fee is considered part of the closing costs, but it's paid for out of pocket at the time of inspection. This person is an unbiased professional who is not really emotionally involved with you or the home. They provide professional insight into the condition of the home, and they give you valuable information for the purchase process. They'll provide you with a report that can help you prepare for upcoming maintenance, repairs, or intended improvements. Notably, this is not an insurance policy, guarantee, or warranty. I feel like we've been asking these as we come up and I can move along. So I want to be mindful of the time here, and I'm going to talk a little bit about our shared equity program, and then we'll be kind of winding down, and I'll be able to send the additional like special programs resources to y'all after the fact. And I really appreciate how engaged everybody's been today. There have been some good questions that have come in. So there are many special programs that can help you buy a home. The three main ways it is that they do this is by increasing your affordability, decreasing your monthly payments, or helping you with the closing costs or down payment program requirements. If you use a special program, you're going to want to make sure that you are aware of some of the extra steps are going to be required from you. You'll need to make sure there's good communication between the lender, yourself, and all the special programs. Organizing documentation and doing the paperwork is going to be something you want to make sure that you're on top of. And then also managing tasks and timelines for different programs is going to be important to keep track of. One special program that can help access affordability for folks who otherwise may not be able to gain a traditional mortgage is our shared equity program. This works by CHT making, I kind of call it like the down payment or an investment into the home to help you purchase now, and this helps future buyers purchase. So I think that this is demonstrate most clearly with like an example. So we have these butternut condos that were available for sale through our shared equity program in Winooski. On the open market, they're appraised for 330K in terms of their value. But this isn't necessarily a super accessible mortgage number for a lot of the households it is that we serve. So in order to bring this lower and make it more affordable, we've put an investment into the property, in this example of $165,000. And that makes it so that way the buyer is really only trying to mortgage $164,000 instead of this full 330. So that makes the monthly costs a lot lower. And I'll talk about that here. So the monthly cost with the open market cost mortgage is like $2,800. But with the investment that was put into the shared equity home, bringing it down, it drops the monthly cost obligations by like $1,000. So this is a lot more sustainable in terms of like successful long-term ownership for a lot of households. When it comes to the shared equity program, there's a few trade-offs, and like there's pros and cons to every program, right? So some benefits are that you have secure housing. You don't need a down payment in our program. You have a lot of savings over time because you're saving on like taxes, even for example, or you just aren't paying for a $330,000 mortgage loan. You're paying for a $160,000 one. You can build up some equity. And it has a positive community impact because this house is going to be affordable forever. That's a really important part. And I'm going to touch base on that again in a second. Ongoing counseling is also available post-purchase within our shared equity program. But there are some trade-offs. You have to have this home as your like primary purchase, and you have to live in it the entire time you own it. There are transaction fees at closing to pay. We have a monthly membership fee for $45. And then you also do have to sell your home back to CHT through the shared equity program to another eligible income buyer. And notably, you receive 25% of the appreciation when you sell. And I'm going to circle back to this on a couple of slides from now. We have some income qualifications in order for people to purchase through the shared equity program. And here it is. Those are broken down over here, and this is available on our website, getahome.org. There's a tab on buying that you can go to and access this information there as well. So I want to talk about how it is that like the resale value is calculated, because this is something that's asked about a lot. So we can say that, for example, an appraiser has determined the market value of a home to be $290,000. This is now, right? You're going to sell it now, and it's 290 now. But when you purchased the home back in the day, it was originally appraised for 235. With CHT's investment, you did not pay this full $235,000. You only paid 162. But we're talking about the market value of the home. The increase in the home's market value, or the appreciation in the home between its original assessed value at 235 to 290, is 55K difference. So when you go to sell, you get 25% of this appreciation, which in this example is $13,750. So you don't get the entirety of the value increase in the appreciation, but you get a chunk of it. And you get all of the equity that you are putting into your principal and interest that you're paying towards your mortgage. That's yours. That's not something that we're touching, unless the home like depreciates in value and then you go to sell it and you end up like owing or being upside down or have some kind of like extenuating circumstance that would end up otherwise making it so that's not the case. We have a couple of internal programs for down payment and closing cost assistance. We have one within our shared equity program for BIPOC households of up to 25K. This is to bridge the gap in homeownership for like BIPOC households, as they have been traditionally literally excluded from participating in the mortgage process. And then we also have a manufactured home loan, which is a 0% interest loan for people that want to replace an old manufactured home or purchase a new one. It becomes due at the time of like purchase, sale, or refinance. But then the rest of these are other partner programs. So that's kind of our CHT ones that are available. I kind of zoomed through the end there. Did that bring anything else up?
I have a real quick question. I don't know much about the manufactured home program. So I've seen a couple things on your website. So can someone go out and find their own manufactured home in their own lot? And you guys would, if they qualified, they'd get the whole loan at 0% interest? Is that what I'm hearing?
So, it does have to be like an Energy Star home. Also, it's really, really, really difficult to acquire any kind of financing for, an existing manufactured home, like a
Yeah, and I know a
pre-existing.
lot of people that have applied through traditional banks that won't do it.
Yeah, so, if it's not going to get financed by a bank, then it's not also really super easily gonna be able to get financed by us. So when people come through, they're, usually replacing or building, an Energy Star, home. I can go ahead and, show some of the language on the website because I think that Sean did a good job putting that together.
Yeah, I was curious about that because on the website, I can't quite understand exactly what the offer is. And I know a few people, actually an employee I'm working with at the site I'm at right now is looking to do this.
Totally. So, it's all over, but these are the amounts and kind of like conditions. So the amount changes depending on like whether it's a zero energy modular home, if it's Energy Star rated and on owned land, or if it's on parked or leased land. Notably, these do have requirements for $2,500 of your own savings just while we're on it.
But
this,
it doesn't look like it's the whole mortgage, like if it's 120,000 for the full mortgage, are these numbers we're looking at the numbers? Or are they just examples? I can't quite read it all.
so you utilize this for like the down payment and closing costs obligation.
Okay, so you still need to have a bank involved. Okay, and that's what I'm curious about because even the banks that were doing it, we're hearing no on now.
Like you have to qualify for a first mortgage or other financing in order to move forward.
Okay. Thank you.
Yeah. Kristen.
Thank you. This was really helpful. Really appreciate all these spotlights that you're providing. Just want to make one comment, especially to Nicole, but you may want to keep it in mind too. So Nicole, in your example of siblings buying a home together, they may want to establish ahead of time how they're going to deal with selling it, because I'm assisting 2 employees right now who have a shared equity home. They want to sell it. Well, one wants to sell it, the other doesn't. They finished their divorce, and it's just really, really difficult because
Got a couple like
one
that.
wants to stay in there, the other doesn't. One of their names is primary on the mortgage and all the CHT documentation, and it's just really contentious. So getting all that established ahead of time would probably be helpful if it's siblings or friends or whomever. But in this case, it was a married couple. Really difficult.
When we've done counseling before, we've recommended like the significance of a lawyer and having somebody that is familiar with the process is really helpful. Cause like sometimes people would be, in this instance, maybe they say, I don't know how it is that I really want all of this to go down when I sell it because I don't necessarily feel I know how it works. So you can encourage people to reach out to the existing resource it is that they already have. Like, a lawyer would be a really good, like person to ask some of the questions to if you have access to them, or like the realtor it is that you're working with is a great person that you can ask these questions to. Your lender is also something that I just find myself saying a lot, so.
And then just double checking, you also offer interpreters. I know you have many classes in different languages. If somebody does not speak those languages, would you have access to get a separate interpreter?
Yeah, we
Great.
have a couple of different options. For most of the folks we counsel, they're through a partnership we have with CBO EO right now, and they have like community ambassadors that are serving as our interpreters. So we like to try and use those folks as much as we can because it's like a familiar face and name and whatnot. But we also have access to a service called Language Line, which I think is either available for like, I don't know if it's for free or if it's for a discount for nonprofits, but there's something there with the terms and conditions that make it like more affordable if you're not using that existing service. And I could follow up if you needed me to, but that's what we use for kind of the more like one-off or intermittent needs.
Great, thank you.
Anything else coming up? I'm gonna type into the chat space. We have our kind of like team email space is education@getahome.org. So if you have any lingering questions or needs, you can absolutely reach out to us that way. You should have my email address also from me sending out like the calendar invitation, so feel free to reach out to me directly with any questions. But other than that, I think, yeah, Bart, what's going on?
I did also just want to point out, since we're here together at Homeowner University, I sent around the email, so everybody should have that flyer on our website. We have 8 classes. I'm really stoked. Some of these classes are rocking. And part of what you were talking about earlier, we actually have a class on Wednesday on wills and trusts. So very specifically for people who are buying a home, it's your largest asset. You should think about what's going to happen to the disposal of that asset at your demise. So like that would be, if people are buying together, that could be a class that they could go to and then have a continued conversation. But Homeowner University, it's 8 classes. It's spread out throughout the whole week. There's some financial classes, there's some home maintenance classes. Some of them are online, some of them are in person. So, we're encouraging as many folks to attend those as possible. It's going to be a good program.
Yeah, it looks like a great program. And it's $40 no matter how many classes you attend. So if somebody's only interested in one of the classes, that would still be $40.
Yeah, we couldn't quite figure out how to scale the payment using the system and the technology we have available. So we just kind of had to go